Welcome everyone. Welcome to this week's market wrap. I have with me Mr. Pankaj Pandey, and I think this was an odd week wherein a lot of stuff happened, and yet we are where we were last week. So, sir, what's happening in the market right now?
Yeah, hi, good evening, Vishu. Yes, this is one of the weeks where nothing much happened. But just to sort of say, when you look at Nifty was down about half a percentage compared to the volatility what we have seen in global peers. So that way, relatively, we are quite better. And so market has been there, or Nifty has been in this range of say 22,400 to 2,600 for most of the. But once you sort of look at sectorally, there was good amount of volatility. We've seen IT as a sector or segment declining by 4.5%. And so this decline was cushioned by a big stock like say Reliance. So from that perspective, that sort of relatively calmed the Nifty. But then again, broader markets continue to witness weakness. We've seen about 3% kind of a crack in mid caps and small caps. Now, our sense is that this volatility related to tariff is here to stay for some period of time, and which is where, while we may relatively do better compared to the global peers, but sense is that on the lower side, 21,800 could be a support and 23,000 on the higher side. I think that is the kind of a range where market is largely expected to sort of spend time. Some relief can be expected from FI buying because FTSE rebalancing exercise could happen next week. Relatively, like I said, we are doing better compared to Dow, and which is what is getting reflected technically also. Then on top of it, we have seen dollar index sort of declining. Crude is down to closer to $70. The yield in US is also sort of down. So all these are positive for us. But I think the volatility is something which is sort of overpowering all these positives, and where we don't have a respite at this point in time. So, which is why we expect that volatility to persist, but relatively we could be doing better compared to the global markets.
Absolutely, sir. I think inflation numbers were also out this week. How does it look?
Oh, yes. So I think inflation numbers definitely brightens up the prospects for rate cut by not only 25 but about 50 bips. We have already seen 25 bips. Now, inflation was at about 3.6%, far lower than the overall expectation of 3.9%. Inflation was 4.3% in the month of Jan. A good part is that the food inflation has started to come down. It was 6% in January. Mind you, 6 months back, this number used to be about 10, 11 odd percent in the month of October. So from those levels, we have definitely come down to about 3.7%. So food inflation is definitely a positive news for us. And I think core inflation, right, it looks higher at 4%, but we also need to understand that there is a base effect which is sort of helping. Good part of all this is that while we are seeing domestic inflation on the lower side, it gives RBI a lot of comfort to sort of do a rate cut. And the kind of action what they're taking on the liquidity side, I think all these rate cuts or potential rate cuts will translate, or you'll see transmission of that also happening. So for us, definitely whether the Fed cut rates or not, but I think we are, at least our data is definitely supporting a rate cut going forward.
Absolutely, sir. So these have been quite volatile times in the recent months. I think Feb was the continuous fourth or fifth month where we saw a fall in Nifty. How have investors been responding to this correction?
Oh, yes. So I think a lot of expectation was that the investors will be sort of panicking, and which is why Feb month inflows was one big number to sort of watch out for. Just to sort of break down this number, total inflows, if you look at, is at about 29,300 compared to say 40,000 for the month of Jan. Now it looks substantially down, but we also need to understand that there were relatively lesser number of NFOs. So if you sort of strip out the NFOs, then the number is 27,000 versus 36,000 kind of a number for Jan. And again, we also need to understand one more aspect is that Feb is obviously a shorter month compared to January. So if you sort of normalize Feb month for the shorter number of days, Then the thing is that the inflows are down to about, or inflows should be read as 30,000 odd crores versus 36,000 crores for the month of Jan. So that's about 17% kind of a decline. Whereas when you read the media, it's talking of 26%, all of it. Uh, uh, so which is where, while yes, some moderation was expected, and I think it's not really a bad number. Now, the other factor is that when you look at the breakup in terms of segment wise, the small cap and mid caps continue to garner far more higher inflows compared to large caps. Now, yes, the decline in small cap is down from monthly inflows from 4,700 to 3,700, mid cap from 5,100 to 3,400. So, large cap typically has been relatively stable from 3,100 odd crores on a monthly basis. It has come down to 2,900. So decline in large cap is less, but the quantum of inflows also has been lesser in large caps. The other thing is that SIP numbers have not taken a meaningful hit. So, for example, you had December SIP numbers of say 26,400 odd crores. This number was largely stable in January as well. What you've got for the month of Feb is about 26,000 odd. So, really not much of a dent, which is what we're seeing. Now, the other factor to sort of look at is what the investors do when the market sort of falls. Now, we've clearly looked at, or one big fear was that you'll see a large or a bigger redemption sort of going forward. But when we sort of look at for the month of Feb, the redemptions have been about 25,000 odd crores. This is against the overall yearly average of some 34,000 odd crores. So, which is clearly depicting that retail investors for sure are not panicking. The other thing to sort of highlight is that when you look at the gross purchases, now gross purchases have sort of come down, and likely so because see when the market had fallen for the first time, which is in October, typically the buying has been a lot more higher, and that is where the gross purchases had gone up to 70,000 on a monthly basis compared to 62,000. So obviously, with the markets not performing, gross purchases were expected to be lower. But some total our sense is that the kind of numbers on the redemption what we're seeing is not really a number which is depicting a panic setting in the market at lower levels, despite the market being down by 5 or 6 odd months. So from that perspective, I take this overall inflows as a positive for our markets. Not to say that we are not going to be volatile. If the world is going to be volatile, we are also going to be volatile. But I think this FAM number definitely suggests that the retail investors are not panicking.
Right. So, a big news of this week was Starlink making its plans to enter India. How is this expected to make an impact on the landscape?
So we need to understand that, earlier both Jio and Bharti Airtel were opposing administrative allocation of spectrum to Starlink because they were fearing that competition will come in and that might impact their return profile. But I think with this kind of a news flow, what is coming out clearly is that they're not going to compete, but they're going to collaborate. So I think which is a big relief for the industry. Now, coming to the terms, overall sense is that both Jio and Airtel will be offering Starlink equipment in their retail stores, and then their services will be offered via network to businesses and other customers, and also to the rural parts of the country. So from that perspective, I think things are good. Now, whether this is going to sort of make sense immediately from a customer perspective remains to be seen because in 2022, when the Starlink was about to come, the expectation was that first year cost for a subscriber would be 1.58 lakh, and which could be dropping to about 1.5 lakh. Obviously, 3 years have passed, a lot of things have happened. So, for example, in Kenya, the company is offering services at about $10 on a monthly basis, whereas in US, this is priced at $120. In Bhutan, for example, they're offering at 3,000 to 4,200. Whereas in India, if you look at the broadband cost is about 1,000 rupees on a monthly basis. So our sense is that both the companies or the entire ecosystem is turning more collaborative than competitive. The exact details will is still sort of not known, but I think one of the biggest worries of the industry has been sort of set aside in terms of a new player entering and then further price competition or whether it is a backdoor entry into overall other services as well. So from that perspective, a big concern of the industry has been put to rest. Although we haven't seen the kind of a price movement, but our sense is that this news is definitely to be taken from a positive perspective. So yes, I think one of the bigger worries have been put to rest. That is what I would say.
Absolutely. Talking about worries, IT sector has been kind of showing some weakness. What is happening there?
Oh yes, I think this is one sector which has taken a significant beating. So while Nifty is down, say about 2 odd percent, and last 1 month IT index is down 12%. It's all again related to US because see, US is the biggest market for Indian IT firms, and we all know that the backdrop or macro backdrop in US is definitely not soothing. Now the challenge is that whether US will see an economic slowdown or an economic recession, I think the verdict is still not out. Inflation also is expected to be higher, so we should not be reading or giving too much weightage to the 2.8% kind of inflation reading which had come by recently, because all these tariff-related impact will be visible in subsequent inflation numbers. So again, the hopes for a rate cut are sort of fading off. So it is possible that the US might witness higher interest rates for a longer period of time. Now, the challenge with IT firms is that 50% of their revenues come from US. And most of the IT companies in Q3 con call have clearly said that they are expecting a stronger FY26. So, which is why the overall growth expectation was higher. So for example, this year, companies would have seen a dollar revenue growth of 5 to 6 odd percent. There was expectation that FY26 the growth could be 7 to 8 odd percent. Now, with all these taper tantrums going on related to tariff, I think this growth or this stronger recovery is not going to pan out. So again, you will see a 5 to 6% kind of a growth. And again, FY27 is the year probably you can rely for a better growth. So I think this kind of a dashing of hopes is impacting the IT sector, and what you're seeing is players like say Infosys, Wipro. Now, these are the companies which derive maximum revenues from a discretionary spend, and that is the segment which will get impacted. So again, IT has taken a beating, and till the time the outlook on US does not improve, the outlook for even IT companies may not really improve. So companies again can be looked at as something like say Persistent or Coforge. I think these companies are talking of double-digit kind of a growth rate compared to the larger peers. But all in all, it's I think there's still a lot more confusion for IT or the sector to sort of not do well or not to sort of recover in a shorter time. So I think this stocks are going to remain in a consolidation mode for a decent period.
Okay, it's a sir, on the flip side, when we say IT has been showing weakness, on the flip side, we see metals which have been shining, to say the least. So, what is happening in the metal sector?
In metals, yes. So when you look at globally, there is a tariff war which has already started. So from Wednesday onwards, this 25% tariff on Canada and even EU has been sort of levied. Uh, but then again, I think the brighter spot for us is that. So I come to that. So for example, look at the price performance. The index, metal index is up about 6%, whereas Nifty down about 2 odd percent. So you're clearly seeing outperformance over 8 odd percent. Now, the brighter side is this is the first time we're hearing that the Director General of Trade Remedies so is going to come up with a safeguard duty of 12 to 15 odd percent within the week on steel imports. And this is subject to prices being lower at, say, HRC prices being lower at $650 per ton. So currently, the domestic prices are lower than this. And so with US imposing, there was a fear that you'll see a lot more imports coming from even friendlier nations like say Japan or other nations or Vietnam. With this kind of a safeguard duty, the metal or the steel players will get protected. And we have already seen signs of that because when the government started talking of safeguard duty, the domestic prices had gone up by about 2.5 or to 3,000 rupees per ton. And with 12 to 15% kind of a safeguard duty, it is possible that the prices could inch up further by about 2 to 3,000 rupees per ton. So from that perspective, this is one sector where the earning trajectory could potentially improve because up till now, this is one of the sectors which has seen a good amount of decline in their earnings. largely because of the massive imports which were sort of coming in. So yes, I think domestic safeguard duty is definitely going to help. But mind you, in case if it does not come, then it is possible that we might lose these gains. But I'm keeping my fingers crossed because this has been due for a very long period of time. For us, the potential target prices may not get revised substantially higher because, if, for example, we have been liking JSW Steel or Jindal Steel and Power. So we were factoring some kind of a safeguard duty to come in. So at 12 to 15 odd percent, there could be a potential 10% kind of upgrade in our prices. So for example, JSW Steel, our target is about 1130. So possibly 10% hike more is what we could expect. But all in all, in this entire market mayhem, I think metal is definitely shining.
Right. Sir, a while back we used to discuss cement sector for its mergers and acquisitions. I think next in the cycle is coming up pharma. We have been hearing a lot of news about mergers and acquisitions. What is happening in the sector?
Oh, yes. So I think a lot of these domestic pharma companies are looking to sort of increase their global presence. So, for example, Sun Pharma, which is the biggest pharmaceutical company. So now this company is sitting on a cash of about $2.5 billion. And what they are doing is that they are acquiring a company called Checkpoint Therapeutics at a price of about $355 million. So since they're sitting on cash, so money is not a challenge. The good part is that this company has largely been focusing on the US market, especially the high margin specialty portfolio. So this acquisition is a step in that direction because our sense is that initial trials for this drug at least provide that the efficacy of this drug is about 47% compared to the already existing blockbuster drug, which is at about 35% for cancer therapy. And if all goes well, the potential peak sales could be about $1 billion for this. So, which is why I think Sun is really walking that specialty path in the US and not really perturbed by the tariff in case if it Trump were to put on the generic side. So that way, I think this company is doing well. Zydus, we've been liking this stock for a number of reasons. Again, they are also looking to focus on the specialty side, but this particular acquisition is something which we haven't really liked, and I'll sort of highlight. So, for example, this company acquired a France-based medical device company called Amplitude, and this again for a significant amount of 2,850 odd crores. Now the valuation looks okay because this company makes a 25% plus kind of a margins, is growing at 5%. Our challenge is that you're a pharmaceutical company and now you're venturing into a medical devices segment, which is a sort of a new segment for you. So while the opportunity pie is fairly large in medical devices segment, but this is a sort of a unrelated diversification for Zydus. So we don't definitely take this news with a positive perspective. But since the overall prospects of the company has been good, so we have a buy rating on the stock. But this is definitely a sort of a more of a unrelated buyout which the company has done. That is the view we are carrying.
Right, right. Sir, we also saw the news of IndusInd Bank logging a big fall this week. What happened there, and how do we look at it?
Oh, yes. So I think this bank has been in the limelight for quite some time. We have already seen since September, the stock has lost half of the value, down more than 50%. Single day, it lost about 27 odd percent, so about 19,000 crore kind of a market cap loss. And for a segment for a disclosure which were to sort of impact 2.35% of their net worth. Now, what this is clearly depicting is that there is a derating of the stock going on. There is a trust deficit investors are carrying. And it's not only a trust deficit with investors. I think this trust deficit is even with the regulators as well, because RBI has allowed the extension of 1 year instead of 3 years to the current MD and CEO. And I think companies' disclosure that they were or they have to sort of provide a 1,550 odd crore in their derivative portfolio. I think somewhere down the line, a lot of questions are being raised in terms of the kind of current processes being followed, and which is why I think stock has taken a good amount of beating. And if this was not sufficient, I think what has also happened historically is that this company had a MFI book of about 32,000 odd crores. 14% of that book had borrowers who had taken multiple loans, say 3 or 4 loans, and these were the borrowers which were sort of under stress. So initial amount of pain was because of that, and I think with this kind of a news flow, the stock has taken a substantial amount of beating. Now, for this stock to sort of get repaired, I think probably our sense is that going forward, the bank will have to look for an external CEO and a CEO. And once the new leadership sort of comes in, that is when the ambiguity can sort of end, and that is when the actual repair can happen. Because from a valuation perspective, this stock is at about zero point 0.8 times. Historically, even in the bad times, it's traded at about 0.7 times. So till the time the clarity does not emerge on the external candidate for CEO and CEO, I think the bank is sort of going to languish. But in case if we get, then it is very much possible that this bank can command 1% price to book value, because it could clearly be sort of doing more than 1% kind of ROA. But then again, it all depends on the kind of steps being taken to repair the overall reputation. So from that perspective, it's a wait and watch. But if there are incrementally positive things, then I think the stock can give decent potential upside.
Absolutely. Well, that was all the questions that I had for this week. We'll be back next week. In the meantime, if you have any questions for Pankaj sir, please do put them down in the comments and we'll get back with the answers. Thank you so much for watching, and thank you so much, Pankaj sir, for your time.
So before I leave, I wish all the viewers a very happy Holi.
First, happy Holi, viewers.
Investment in securities market are subject to market risk. Read all the related documents carefully before investing.